Good morning and welcome to this week where we're talking about basics of bookkeeping. So accounting concepts and the basics of bookkeeping is a really dry subject and kind of thing that puts most people to sleep. But it's really, really important that you understand why your accountant does things in the way that they do sometimes, and sometimes why you should do things in a slightly different way. So it's really, really important to measure cash and to measure what goes in and out of your accounts so that you can then manage what you measure. So you track what comes in, track what goes out, and then you manage what you're measuring. So this basic accounting data is what underpins your financial accounts. It underpins your tax returns, your VAT returns, if you're VAT registered. Super important to get this kind of stuff right and get the very basics right from day one. And then you'll have better quality information for making your management decisions. So why should we do it? Well, underpins your accounting data, we know that. It's really important to make sure that you don't miss out on anything. So what we often see as accountants is client has been working all the way through the year quite happily in what happens in their bank account, but then they've forgotten that they've made personal spends through their credit card account or personal spends through a PayPal account. And then all of a sudden, you get to the end of the year, you think you're doing really well and you're quite profitable, but actually there are all these missing costs that you haven't accounted for. Or as in a recent PayPal account review that we did for one of our clients, what we actually found was a whole load of income that was received into the PayPal account, drawn down into the personal account, but had been forgotten in his business account. So actually, his business had done better than he had anticipated because all of this forgotten income. Mm-hmm. So the point is not to miss anything and not to have any surprises. So it's super important as well to track in your income and expenses. It allows you to see what your net profits and losses are so that you can understand the scale and the size of your tax liabilities. So whether you're paying corporation tax as a limited company or personal tax as a sole trader or partnership, you still have a better idea of understanding how profitable you are and therefore what your tax bill is likely to be and therefore how much tax you need to put away if you track your accounts properly. So first things first, there's two types of accounting. There's single entry accounting and then there's double entry accounting. And what does that mean? Single entry accounting is where you're taking all the transactions onto your bank account and you're just posting them directly to, say, sales or purchases or consultancy or wages costs. If you're double entry accounting, then you've got two sets of transactions. So instead of going straight from the bank, so say I'm spending £100 on consultancy, I would credit my bank as the cash goes out and debit my consultancy account. Double entry accounting takes into account the thing that happens in between. So your supplier will invoice you for £100 worth of consultancy. So you have your debit to consultancy, but you have £100 as a liability in your balance sheet as an aged payable, as a creditor. So you owe your creditor £100. Next month, you pay that £100. So then you pay off your creditor as the cash goes out of your bank. So there's the step in between the invoice being received and the payment being made, which is what double entry accounting is all about. So who should use double entry and who should use single entry? Well, single entry is really good if you're not VAT registered, you're super small, freelancer perhaps, or just someone starting out, and double entry is single entry is quick and easy. But it doesn't show you how much you owe somebody or how much somebody owes you at any point in time. So we prefer, typical accountants, we prefer double entry, which means you're always tracking the invoices coming in and going out so that you know who owes you and who you owe. And then the payments that often go, say, in a different time period, next month, next week, sometimes in the next accounting year, keeps all of your costs in the right year. Now, that sounds a little more complicated, but does lead us quite nicely into our accounting concepts. There are 4 accounting concepts that we mainly work by. There are lots more in the background that determine how we run the clients' businesses and what we do as accountants. But there are 4 accounting concepts that Harry's going to talk you through now that relate to your business.
Yeah, we didn't want to swamp you with all of them when the main 4 are most relevant to the business owner and to the bookkeeper. So the first concept we're going to explain a little bit more about is the accrual concept. So this one in particular focuses on income and cost recognition. So what exactly do we mean by that? Well, we mean if you have a sale raised in this year, but actually say it's a 3-month project, what we would actually have to do is reallocate or redistribute the income from that invoice across the period it relates to. So most common occurrence is, like I just said, with a 3-month consultancy project. So you may have an invoice raised in January, which relates to January, February, and March. Now, when you've raised the invoice, all of the income is currently sitting in a single month. But what should be happening is it should be a portion to January, February, and March based on how much of the invoice relates to each month in particular. Likewise, if you have a project like this, you'll probably find that your costs come in February, March, and April. So what we should also be doing with those costs is also distributing them across these months as well. So what you get is essentially, if you haven't applied the accrual concept, you get a mismatch of income and costs. And really, really crucial part here, if that happens to cross over financial years, that can cause you a bit of an issue of either overstating your income, underdeclaring your cost, and vice versa. So it's really, really important to have the income and the costs in the correct month. If they're not, you don't have as much access to the information which allows you to make informed business decisions. So really, really useful on that. Definitely one to apply and definitely one to always be considering.
It's probably the most important concept, isn't it? It's the one that affects people's day-to-day accounts. And what your accountant does at your month end.
And a really key part here, linking into our next concept, is not a pick and choose scenario. You can't pick which invoices you're going to apply it to and which ones you aren't. It's an all or nothing approach, which leads us on to the consistency concept. So basically, your accounting policies between each year and each month all need to be consistent moving forwards.
Well, they should be consistent unless you have a fundamental shift in the way you run your business, in which case you can report an accounting policy change in your end of year accounts. But generally speaking, Harry's right, they should be consistent from one year to the next, unless there's a good reason to change them.
And it does happen. But generally speaking, you'll be aware when there is a significant change. But what we mean by consistency in particular is, say, you shouldn't be depreciating an asset over 3 years, 1 year, and then next year suddenly decide you're just going to change it to a 5-year depreciation schedule.
Without back to 3 again.
It should be consistent each year. Obviously, that's a blaringly obvious change, but you kind of understand the concept. It should be consistent. So it relates to accounting policies, like depreciation, capitalizing website development, and of course any sort of income deferrals, unless of course, as Lisa mentioned, you change your business activities, change the way you manage things changes completely, in which case then
I mean, we've had clients in the past that have deferred income for one reason or another, because it was right under the accrual concept, but then the change in their business made us change the way we look at that, and so then we've not deferred some of the income for different reasons. So there are reasonable exceptions to this rule, or it's not really a rule, it's a concept, but the accounting standards and the rules behind it are all based on these concepts, this framework, the guidelines. So they aren't rules, but they are. There are rules that you have to follow when you report statutory accounts.
As long as it is justified, which once again leads on to the next accounting concept, which is the prudence concept. So basically, prudence concept is, have you done your due diligence? Are your accounts reasonable and fair? And are your calculations justified? So these all link in quite tightly, actually, really. So basically, You can't accrue £100,000 worth of sales at your year end
just because
you feel like it. Yeah,
because your sales don't look high enough, so you just want to bump them up a little bit.
I've made 100k loss. Let's make it a break even. Yeah. It has to be justified. If you cannot justify it, it's not a realistic or a reasonable set of accounts, and it's misleading to external parties. Likewise, you can't accrue £95,000 worth of costs just to wipe out your tax bill because it seems like a good idea. That is,
and we have seen really that kind of thing happen before, quite innocently, when business owners have come to us and said, "I've just put through an extra this, or I've just put an extra that because I couldn't afford to pay my tax this year." That is really, unfortunately, that's unfortunate. That's really sad to say, but that's not allowed. We have to go to the tax man with an honest and justified result, and then negotiate with them to paying the tax bill.
Yeah. So really, really important, because if you're applying, when you prepare the annual accounts, you're basically saying, yeah, these accounts are fair and they're
true
reasonable.
And fair. They've got to be true and fair. That's the definition.
And bear in mind, your actual accounting, your actual annual accounts are going to be possibly viewed by external parties if you're seeking investment, if you're going for extra shareholders, etc.
Yeah.
So if they are misleading, that is really, really not good
and helpful,
and really not helpful.
Yeah.
And it could hinder you in future.
Yeah. So if you ever hear your accountant talking about the accrual concept, consistency, going concern, or prudence. So going concern is one we haven't quite touched on. Going concern means that the underlying concept when you're reporting a set of accounts is that the business is a going concern and it's viable. But sometimes, for whatever reasons, the balance sheet will be negative and you'll have net assets or net liabilities rather than net positive assets. In that case, your accountant will have to put in a going concern statement to say that, the balance sheet is negative for whatever reason, but the directors believe that the company will return to profit and will continue to support it financially until that time, usually in the next financial year. So those four concepts are really, really important. So you'll often hear your accountant talk about, accruals and prepayments, deferrals and adjustments to the management accounts. They're not manipulations just for the sake of it. They are all because of these concepts of accruals and of the accrual concept and prudence, to try and put things in the right place at the right time to make sure that you're better prepared for your end of year accounts, that your accounts are accurate and up to date, that they're true and fair representation of your trading activity during the year, whether that be a profit or a loss.
Oh dear,
I just lost Facebook.
Potentially lost signal.
That's the first time, isn't it?
That is the first time. Because I don't know if it actually...
on YouTube as well. No, YouTube looks live.
Oh, I wonder if it's a Facebook error. Oh dear. The fun of live recording, I guess.
I know,
always
right?
happens. This is the first time it's happened, actually.
Yeah,
it's really weird,
isn't it?
So while we try to reconnect, we've got to remember where on earth we got to before it trailed off.
Yeah, we were just there.
Understanding, yeah.
Yeah, so for those who have joined us on YouTube, the whole point of doing all this and making sure that our accounts are accurate and fair is so that you can understand your business performance, is so that we can report true and fair profits, and also that your balance sheet is a true and fair representation of your assets and liabilities. So your accounts have to be in a format and reasonable enough that the person reviewing them or reading them once they're published can make an informed decision on your business. So that's it for now. Thank you very much, and we'll join you tomorrow, hopefully without any connection issues.
Which we may need to record.
Which we may need, yes.
Bye.
Bye for now.